Let's go to Singapore and speak to Arjuna Mahendran, who's the head of investment strategy for Asia at HSBC Private Bank. Many thanks indeed for joining us, Arjuna, this morning. Look at your research. You said the global recession is not on the cards, but you do criticise, as many have done, the bad leadership out of Europe and the US, and if they don't get their act together, they're going to risk a major sovereign debt, which will lead to a recession either next year or the year after.
Indeed. I think what you're seeing right now is that the Germans in particular in Europe haven't felt the pain of the potential consequences of their actions, politically and otherwise. So until the effects of a pretty nasty recession are felt and unemployment starts rising amongst German voters, unfortunately their government, I think, will not respond quickly enough to this growing sort of cancer of illiquidity, which I think is threatening to bring the whole euro area down into recession. I think countries like Spain and Italy are probably already in recession, and it's only a matter of time before that spreads into the larger countries. So really I think it's a question of the sort of political will not being there amongst the larger countries, Spain and Germany and France in particular, to really bite the bullet. I mean, it is the case that we'll probably see some movement on fiscal moves towards fiscal union and coordination when the heads of government meet next week, but we're not expecting any positive surprises, at least in terms of market-friendly initiatives.
When you criticise Germany, you're referring to the fact that they don't want to give the ECB more firepower, and also they're very much against this Eurobond idea.
Absolutely. I mean, the point is you don't even have to go for the Eurobond. If the ECB started buying some of the debt of countries like Italy and Spain, you'd immediately see a compression in spreads, and that would, I think, settle a lot of this fear in the bond markets. But the Germans are not even able to countenance that. So very clearly, they've decided not to go for the easy option, which is a pity, because I think in the short term it could mean a lot of pain, unnecessary pain, for most of Europe.
But is it wise to go for the easy option, create money, just pump more money into the system? Is that the right way forward?
Well, I mean, it's a matter of debate, obviously. It's a question of incentives, etc. But, in the United States, they did it 3 years ago, and it worked. And, of course, the United States has its own fiscal problems, as we can see. Perhaps the fact that they took the easy option meant that they didn't deal with the underlying imbalances, you could argue. So the Europeans are taking the diametrically opposite position. But the point is, I think there is still room for a trade-off. You can actually implement at least part of the easy option so long as there's good faith. And we've seen a lot of pain in countries like Italy and Greece already. Governments have been toppled, new prime ministers appointed. So I think that really shows that there is a will now to change the basic structure of the system, which means that you could probably go in for some short-term measures without really jeopardizing the longer-term project.
Looking therefore to your allocation, Arjuna, I want to say equities, again, you say the concern is about high risk premium, but also commodities to remain subdued, currencies, dollar weakness going forward. Interestingly, you mentioned about the bonds and, of course, Germany's reluctance to give the ECB as much firepower as it really should have. They look unattractive in your view. But also the slowing inflation here in the emerging economies, that's been also an issue for bonds, isn't it?
It is indeed. This is very interesting because, I mean, this is a bond-friendly environment. I think the chances are, if Europe does tip into recession and drag the United States down into a lower growth trajectory, then obviously bonds, particularly longer-term bonds, will do quite well. And as you mentioned, in Asia and emerging markets, I think inflation has probably peaked. It certainly seems to have in China, which normally would be a fairly bullish signal. But I think given the fact that emerging economies have over-borrowed themselves, particularly on the consumer side, there's very little space for them to reflate in the short term. And therefore, I don't really see much of a growth impetus coming out of emerging economies, at least for the next 6 months. So overall, I'd say that it's a bond-friendly environment. I don't think equities really have the chance to outperform at least till the middle of next year at the earliest.
Thank you for your time there, Arjuna Mahendran, the HSBC Private Bank, the head of investment strategy for Asia.